Welcome to County Portal, your simple source for local government services and public records. Let's get started.
Today we're breaking down a specific IRS term, tax liability for 2210 purposes. This isn't just the final number you see on your tax return, like the refund you're getting or the amount you have to pay. It's a very specific calculation the IRS uses to determine if you owe a penalty for not paying enough tax throughout the year. The US has a pay-as-you-go tax system, which means you're expected to pay your taxes as you earn income, not all at once on April 15th. If you don't, you might have to file Form 2210 and face an underpayment penalty. So, what is this special tax liability number? It's your total tax obligation for the year before you account for the money you've already paid in. Let's get into the details. First, this liability includes your regular income tax. It also includes other major taxes like the Alternative Minimum Tax, AMT, if that applies to you. Crucially for freelancers and business owners, it also includes your self-employment taxes. Other taxes, like the net investment income tax or the additional Medicare tax, are also part of this total. To make it tangible, you can find this number on your Form 1040. For the 2023 tax year, this total tax is on line 24. Now, here's the part that trips people up, what this calculation ignores for penalty purposes. This liability is figured before you subtract your federal income tax withholding from your paychecks and before you subtract most of your tax credits, especially refundable credits. Think of credits like the Child Tax Credit or the American Opportunity Credit. While they absolutely reduce the tax you ultimately owe, for the purpose of the 2210 penalty calculation, the IRS looks at your tax liability before these credits are applied. Withholding and refundable credits are treated as payments you made during the year, not as a reduction of your core tax liability. This distinction is everything. Why does it matter? Because this number is the benchmark for the IRS safe harbor rules, which are your ticket to avoiding the penalty. There are two main rules. Rule 1, you must have paid at least 90% of your current year's tax liability, which is the number we've just defined. Rule 2, you must have paid at least 100% of your prior year's tax liability. This second rule is a lifesaver, especially if your income went up significantly. One small catch: if your prior year's adjusted gross income, or AGI, was over $150,000, that 100% rule becomes 110%. So, in short, your tax liability for 2210 purposes is your total tax bill before considering withholding or refundable credits. It's the target you need to hit to stay penalty-free. Thanks so much for watching. If you found this helpful, please hit the like button and be sure to subscribe to the channel for more simple explanations of complex tax topics. We appreciate your support.